Good evening, everyone. I hope you've had an interesting trading so far. Today is the first day of this week, and there's a lot to cover. And I'm going to be taking you through smart money concepts. Just going to talk about the basics. My name is Samson Mzera, and if you can hear me, just say hi in the chat section so that I know my connection is clear. I'd really appreciate that. Anyway, so today we're going to talk about one topic that has been really trending in the trading community, in most of these trading communities, and that is the concept of smart money concept. Hilda Nekesa saying thank you too. So if you can hear me, just say hi in the chats. We are going to do a summary. We're going to do a summary of smart money concepts, and hopefully it's going to guide you when you're working on your strategy. So this is one of the latest strategies in the market, and I see a lot of traders adapting to it. And it's something that I think if you master properly, there are a lot of opportunities in that space. So hi guys, hi George, hi Charles, hi James. What's trending? Hey, yeah. So let's quickly move on to. My name is Samson, and let's see what smart money concepts has in store for us. Okay, so there are 5 things that we need to understand from smart money concepts that you'll need to remember later. The first one is order blocks. Second one is balance and imbalance. I hope you're taking notes. The third one is mitigation. The fourth one is market structure. The fifth one is fair value gaps. So you can spend some time on each one of these concepts to make sure you have a good understanding of them. Again, order blocks, balance and imbalance, mitigation, market structure, and fair value gaps. So you're going to go through each one of them, and then you're going to combine them. And that's going to give us a strategy. Hilda is saying, amazing teacher. Yeah, thank you for that, Hilda. I'm hoping these concepts are going to be of value for the day. And I think I see a lot of traders using these concepts these days. And I also think they're very effective, especially when you're trying to get started with trading and when you are already used to the more advanced concepts in market structure. So the first concept is order blocks. And let's quickly dive into what an order block is. So an order block is defined as an area where large entries in the market were made, and this resulted into a very big push in the market. You're going to see this happening in the charts. So order blocks are used by institutions to split big orders into chunks so they get filled at better prices without disturbing the market equilibrium. So it's a very abstract concept to think about, but you can identify where there was a huge demand area or a huge area where guys started selling immediately in the market. And if you can identify this, then you can use it as part of your strategy into identifying some of these other concepts that give you an entry. So the question is, where can I see on the chart areas where a sudden influx of buyers or a sudden influx of sellers came into the market and drove prices either downwards or upwards. So an order block can be identified by a specific candlestick or a bar that, when properly viewed in institutional concepts, can highlight smart money buying and selling. So this is part of the smart money theory of trading, which is a very new. It's been trending for the past 2-3 years, if I may say so. And the idea is there is a gap between institutional traders and retail traders, and that the fact that we can see these footprints of these large institutions based on certain characteristics on the chart. And one of them is this, the concept of order block, that is order blocks. Institutional context means observing market behavior that reveals the pileup of orders by large entities. Yeah, and that's behind the idea of order blocks. You're trying to see where large buyers came into the market and pushed prices. So look at this chart that I'm demonstrating over here. There are two types of order blocks. There's a bullish order block and a bearish order block. They're saying a bullish order block is a down candle at or near a support level before an upwards push. So in this case, look at this carefully. We had this last candle, yeah, and then we had an upwards push. So the bullish order block is this last downwards candle before we had this upwards push. And that's what they're saying, that the idea that it was at this point, this was the final candle before we started seeing a large influx of buy orders. Remember, market prices or the market moves because of either supply or demand. So if there is too much demand, then prices go up. And if there's too much supply, prices go down. So in this case, at what point do you start seeing demand entering? It was at the last bearish candle, and that's when we had our push upwards. So keep this in mind while we go through the next section. Then a bearish order block is the opposite of this. This was the last upwards candle before we had a push downwards. So it's very interesting that this is the opposite of what we had then. And basically, you're trying to read into what caused selling pressure into the market. At what point can we determine that this is where the selling started? And usually it's when the last candle had the last upwards candle before the downwards move. And you're going to see an example of this in the chart. Okay. The second concept, if I was to go back to this, the second concept is an imbalance and a balance. So what's imbalance and balance in the market? Firstly, remember that you've defined an order block as the last bullish or bearish candle before an upwards or downwards move. So the next thing is, what's an imbalance really? And how does that tie into the concept of order blocks and smart money concepts? Again, remember, the concept of order blocks is very dense. You can find a lot of information as to how you can refine the idea of order blocks, how you can find perfect order blocks in the market. What you're doing is very shallow, and it requires you to go 1 or 2 steps further just to know exactly how to identify an order block. But the layman's definition is what we've just discussed, and you can rewind on this YouTube session just to have an understanding of that. So the next concept is balance and imbalance, and we're going to talk about that. So this is imbalance is simply insufficient trading in the market. So I'm going to define all these concepts. We're going to hop onto a chart, and we're going to define all these concepts one more time in the context of we are looking at a chart. So don't worry if you feel like this is too abstract, you don't understand what's happening. Just understand the definitions, and then when we jump or we hop over to the charts, it will become more clearer. So imbalance is when there is insufficient trading in the market. It is sometimes called a liquidity void. When there is insufficient trading in the market, the price often comes back to fill out the orders that were left before proceeding. When an institution wants to place an order at a certain level, it is assumed that there are enough sell orders to pair with buy orders. Remember the natural... Okay, I was reading the comment from Hilda while we gone. So remember, the natural state in the market is all buy orders have to be matched with sell orders. But if you have an event in the market where prices move too swiftly in one direction, then it becomes an issue, because not all orders, assuming, have been filled, or the guys who are holding losses because the prices moved so suddenly, and this can be an issue in the market. So we can use this to assume that sell orders that were available at the level were not enough to pair with buy orders, or vice versa. So we'll talk about this when we come back. Then the other concept we need to introduce, again, if you feel like these concepts are too abstract at the moment, you can just go back, go through them one by one. You can have entire YouTube videos just for each concept before you combine them into a strategy. The second concept is the concept of mitigation. A mitigation block is a reversal pattern. It occurs when the market fails to make a higher high or a lower low. It results from a failure in the failure swing in the market. So this is simply the act of prices coming back to the order block because there was a certain imbalance somewhere in the market. Yeah. And then the last concept is the concept of market structure, which is what we will use to make a trade in this market. So market structure is simply the art of spotting new trends based on how price is organized on the charts. I'm sure there's an entire session of market structure, and if you do not know what market structure is, I'd recommend that you either attend one of the centers or just contact FXpressor handles or personal handles, Samson Mzera on all social media platforms, and you'll have a proper guide onto what market structure is. But this is the final item on this puzzle that we call a strategy for SMC that you're building that will help you identify entry setups. But if you're able to identify when a trend is changing, for example, if we know an uptrend is a series of higher highs and higher lows, and a downtrend is a series of lower lows and lower highs, then you can identify when the market is changing from an uptrend or a downtrend. Yeah, okay. Now, if I was to go back to this, you've identified what order blocks are. The last candle before an up move, the last down candle before an up move, or the last up candle before a down move. You've identified balance and imbalance. You've identified what mitigation is, which is the act of prices coming back to the order block. You've identified market structure. And fair value gaps is simply an extension of this concept of balance and imbalance, where the market has to come back to a gap or an imbalance. So a fair value gap is simply an imbalance in the market. If the market has to come back to an imbalance before proceeding, we call that a fair value gap. So I'm going to quickly switch over to the charts. And today we had a very nice example on gold that we're going to examine, and we will call that a strategy for the day. So let me just hop over to the gold chart. So I hope you can see my screen. Let me try and compress all those concepts we've learned into one neat strategy that we can use. We have three concepts, and you're going to use our chart here to identify those in a minute. Okay, so if I zoom in, into this chart, let me remove this. If I zoom in here, H4, that, yeah. So, okay, so take note of this move over here, yeah. So I'm going to go to properties and change this to maybe something conspicuous like that, yeah. I'm going to go to H4, okay. So the best time to identify order blocks is when you're in a higher time frame. So I've highlighted this area over here, and look at this last up candle before we had a downwards push. So the last up candle before a downwards push is our order block. And in this case, I've highlighted this area over here as our order block. Yeah. So an order block is the last the up candle, in this case before down. So I can tell that this is where a lot of the selling started. Yeah. Then what did we have afterwards? We had a very strong push downwards. In this case, if I was to go to the H1, it becomes more clear. We had these strong pushes upwards, downwards. And what did it create? It created areas of imbalance. Why? Because the market moved in such a strong wave that it didn't have time for prices to both fill. Yeah. So the market moved in such a strong wave that it didn't have time for both buyers to participate in this market. Remember, in this case, we just had selling candles. There was no buying candles at the moment. Yeah. So this was our imbalance here. So we had an upwards push and then a downwards push. So this was our order block. And then this was our imbalance. So what happened? This was Thursday last week. This was Friday. Yeah. On Friday, market went back up into this order block. Yeah. Order block that we had identified on our 4-hour time frame as the last upwards candle before a downwards move. The market rallied back into this point, and this act of rallying back into this point is called mitigation. Why is the market mitigating? It's mitigating the fact that we didn't have equal buyers and sellers when we were coming down initially. So the market has to go and mitigate that point. So as a trader, if I see mitigation happening at an order block, then that's when I think of, okay, this move here isn't an upward trend, it's just mitigating this move. So there's a high likelihood that this move is temporary and we will have prices continuing downwards. So in this move, we have to study it on a lower time frame to understand the anatomy and the market structure that will guide us on finding a reversal on this move. Because the explanation of this is the move on the lower time frame. Now the market going all the way up here and then into this area, just tapped into it, and then we decided we're going lower. So in this case, I will look for higher highs and higher lows, which is where our market structure comes into place. So higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. So in this case, we broke this low, and I'll be looking. So remember, there was a low here. Market structure is a series of higher highs and higher lows. There was this move that broke the previous low, and then we had a retracement down here, and then finally, after some time, the market eventually melted away back to our area here. So yes, indeed, we had the move back into the order block, but after some time, we did see us going lower. So what happened? Market formed an order block, formed an imbalance, came back into that order block, and then proceeded going lower. It's a very straightforward concept. Those are the 4 things you need to know. Order block, imbalance, mitigation, and once you find the imbalance and mitigation, you go down to the lower time frame and try and identify market structure that will help you get an entry into the market. And then if you look at all these trends, you can simply explain everything in terms of balance and imbalance. Look at this, for example, over here. These big candles here were creating an imbalance. So if I was to go to 4-hour time frame, it will be clearer. Yeah. So let me highlight this. The last bullish candle before a downwards move. So these candles here, this one over here, the last bullish candle before a downwards move. The best imbalances are when you see big downwards candle without any bullish candles on them. If you just see, for example, my bearish candles are black. So if I just see a series of big black candles and I start seeing prices reversing, I know they are mitigating this downwards candles. And once I see the mitigation is complete up to the order block, I start thinking of selling. So once I see this is mitigation, the act of prices coming back from this imbalance that was created, because remember, this was the last bullish candle before prices going down. So this rectangle is just marking the range of this candle. Once you see that upwards move, then the next thing I'll do is start looking for market structure on the lower time frame that I can find sells on it. Yeah, it's very simple. Don't try and complicate it. Don't try and make it fancy or anything. It's a very simple concept that I'm sure if you master, then it's something that is worth using. For example, another area, I'm sure you can see this entire region that I had marked here, that we had this push upwards. Yeah. So on Friday and the better part of today, prices came back into this order block. This is the last down candle before we had this push. And that's where prices touched on Thursday when you had the news coming out. Yeah, this is where prices touched, and this is where you're looking to go long. Yeah. So I'm going to go back to our charts and define the stages clearly, and then hopefully you can use that for your analysis. You don't need anything else. You just need knowing what an order block is, being able to identify it. The best order blocks are the ones that after the order block, that move has created an imbalance. Just look for big candles, yeah, that pushed the market in one side, and then look for mitigation. Mitigation is the act of the market coming back into that order block and feeling that imbalance. Once you're done with that, just make sure to wait for a change in market structure and then use a fair value gap to enter. So this is fairly straightforward. All of these concepts are very strict. My screen is paused, so just a minute. Okay. Yeah, so order block, imbalance, mitigation, and then market structure to enter. Very straightforward. You can expound on these concepts on your own, but I believe this is very effective, and I see a lot of traders attempting to use this. On Friday, for example, we had a lot of traders attempting to buy gold, and the reason being we could all spot the imbalance in the markets. So if you look at the long run, in the 4-hour, the last bearish candle before the upwards move was your order block, and then markets melted down to this order block here, and then a lot of traders were trying to buy to take these prices back up. Make sense? I hope it does. It's good to keep your concepts very simple. And if you don't, if you're not understanding what you're talking about, just rewind the video and then slowly play it to get an idea of what is happening. Yeah, you have the concept of order block. So let's look at another chart. Can randomly identify any chart. If you pick, for example, AUD, USD, then here I can tell that. Let's look at the 4-hour time frame. Yeah, I had identified one over here. So when I'm doing my analysis personally, this is what I'll use. I'll try and identify order blocks and then wait for mitigation. And then from that, I will try and make my trade from there. So I had one order block over here, and I think this is a more effective one over here. So let me just carry this here. So look at this uptrend, this strong uptrend. The last bearish candle, downwards candle before this move was here. Yeah, prices pushed upwards, came back to this region where the last, so this push created an imbalance. If you can look it over the daily, you will see some sort of imbalance from here. And then what happened is prices melted down back into that order block over here, and then that's where we look for market structure to buy back and take it higher. Simple as it is. The only thing that you need to watch out for is your fundamental analysis. If there's any news that's suggesting that, for example, Australian dollar should be lower, then that's when you should be careful about it. And I'm always marking supply and demand. Look at this mini supply demand zone we had over here. Yeah, the last upwards candle before a downwards move, waited for prices to come back into this move, and then sold back lower. Yeah, from just this move here, we were able to get another sell. Yeah, it's very effective. It doesn't require a lot of planning. It doesn't require a lot of studying. You just need to know where and when to react. Yeah, look at this strong downwards move over here. I can tell that in this case, I'll be looking for zones. Which one was taken out over here? So you can see that there's this downwards candle that prices pushed lower, came back into that level, and this is where you'll be looking to sell. So this is mitigation, and that's where you'll be selling. Another zone is over here. So if I see prices coming back to this block over here, where we started having a lot of selling, then next time I see prices coming back to this region, that's where I'll be looking to see where the shorts are. And if you look at the market snapshot series, this is what I'm always looking at. I don't make it complicated or anything. This is what I'm always looking at, and it's something that you can use in your analysis and make it make sense. It's very effective. Trust me, if you backtest this, you have a way to trade the markets that is very effective. Having said that, thanks for attending this session. We usually have market snapshot series every day at 11. I usually host market snapshot series every Friday. We had CPI coming out to non-farm coming out last week, and CPI coming out, I think, is on Wednesday. So we'll have a good session this week. So make sure to attend 11 a.m. and we'll discuss everything. So make sure to combine your technical analysis and your fundamental analysis to get the most effective strategies. Today was a very good trading day because we had identified all these regions and we were looking for buys, which we had a brief buy in gold, and then the markets just dropped back downwards. But it was a very good session, and all we were using was order blocks, mitigation, imbalances, and I think those concepts work very well, especially for day traders, and it's something that you have to look at if you're into trading. Having said that, thank you for attending, and see you in the next trading session. See you on Friday. We'll be covering what has happened for the week fundamentally, and when I explain those concepts, I usually have, when I get to technical analysis, you'll hear me talking about imbalances, order blocks, or supply or demand zones. And that's when this specific webinar will be very effective into understanding how the analysis is going. So make sure you have that in mind. And again, thanks for attending the webinar and the session. See you on Friday. Tomorrow we have a session at 11, and also make sure you've attended that for more analysis. Having said that, have a good evening. I'll answer most of the questions on Friday, 11 a.m. If you have time, make sure to attend that, and we will see how the market goes for this week. On Wednesday, we have CPI, so be very careful with that. But other than that, have a good trading session and a profitable week.